Welcome and thank you for standing by. At this time, all participants will be on a listen-only mode. This call is being recorded. If you have any objections, you may disconnect at this point. I'd like to turn over the call to your host, Sally Brandon, Vice President of Client Services at Rebalance IRA. Sally, you may begin now.
Don, thanks so much. Good afternoon, everyone, and thank you for joining us for today's Rebalance IRA Spring Conference Call, focusing on the first quarter of 2017. I want to first say a special welcome to all Rebalance IRA clients, prospective clients, employees, and friends who are joining us and listening in this afternoon. We'll begin in just a moment with comments from Rebalance IRA Managing Director and Chief Investment Officer, Mitch Tuchman. After comments from Mitch, we'll respond to client questions that we've received over the last 3 months. Clients are always welcome to submit questions via email to info@rebalance-ira.com for future conference calls. A digital playback of the call will be available on our website at rebalance-ira.com/conference. Please refer to our public filings with the SEC on the legal link at the bottom of the Rebalance IRA website for information on the various risks and uncertainties. Mitch, we're ready to get started.
Great, Sally, thanks a lot. And just wanted to welcome everybody to this call. It's been a pretty interesting quarter, to say the least. We have a new president in the White House, and all kinds of things have been changing all around us. So first I want to just kind of go through the market, talk about our portfolios and some of the performance, and then go through this quarter's topic, which we have in our quarterly newsletter about being the house instead of being the drunken guest at the house, referring to the markets and casinos, which I think is an apt metaphor. Also, there's a bunch of calls and questions we've received over the last few months from clients, and they've been fielded by Sally. So we like questions, and we're going to address a few of those during this call today. So if you have any questions for the next conference call, please send them to info@rebalance-ira.com, and then Sally can get them, and we can get them up for the next conference call. So at any rate, let's talk about the markets first. It's on everybody's mind, and we watch the markets. The U.S. market's been on an 8-year bull run. There's a lot of uncertainty as to whether that can be sustained or not. And the long bull market in stocks and some other assets, in our opinion, are largely justified by true fundamentals. People believe that a lot of the increase in the U.S. stock market prices or their rebalanced portfolio is because of some of the pro-growth policies of the Trump administration or lowered taxes and the expectation of that. But there's really a lot of other supportive factors, even if Washington doesn't provide much in the way of tax cuts or other policy changes that investors are expecting. Let me just point out a few of those. One is that we at Rebalance IRA always tell our clients, hey, I know you look at the market, and when you turn on TV, I was looking at CNBC this morning, and in the bottom right, it's always the NASDAQ and the Dow and the S&P, and we are fixated and focused on the U.S. stock markets as citizens of the U.S. And the fact is, if you look at all the publicly traded stocks and bonds that you can possibly invest in the world, the U.S. is only a little less than half of the available opportunity for an investor. And that's why with our portfolios, we invest globally, because different economies are doing different things at different times. And there's a lot of scientific evidence showing that if you have a globally balanced portfolio, you reduce a lot of risk. And so one of the things that's really been happening finally after a few years is that the foreign markets are really beginning to move. So key overseas economies like Europe, China's stabilizing. There's been modest improvement in Japan. These economies have been weak on a prolonged basis. So right now, the reason rebalanced portfolios are up is not just about the U.S. It's about a global, kicking in of activity. So, for example, our portfolios this quarter were up between 2.6 on the low end on our income portfolio and they were up well above 6% for our growth portfolio. And I want to mention that that's using back-tested software. It's not actual client accounts, and that back-testing methodology is on our website at rebalance-ira.com/backtesting. But they're fairly accurate, and really are as accurate as I think software can be as possible. But really what's driving all of that is that, for example, emerging markets, Brazil, Russia, India, China in the last 3 months, those economies and the fund that we use for our client portfolio, that was up over 11%. The US was up half of that. It was up 5.7%. Small US companies, which had a great year last year, up almost 27%. They're up, less than 1% this year so far. Same with real estate, up under 1% so far this year. The developed markets, Japan, China, Russia, Europe and Japan, those are up 8%. So everything is doing better than all things related to the United States this year. So when you look at a rebalanced portfolio that's up, the diversified growth, for example, slightly over 5%, well, the whole US market's up about that much. So this portfolio is very well diversified with a lot of bond funds, and it's still doing as well as the US. So I really caution clients. We have a lot of discussions about this. We buy globally balanced portfolios. We're getting paid a lot for that now. That is why your portfolio is up quite a bit this year, and maybe others are not. And that is another driver of portfolios. The other is just lower rates. When you have low interest rates like we do today by historical standards, even though the Fed has just made 3 quarter-point rate increases, investors need assets that will give them acceptable returns. And so when bond returns are low, people start paying up for stocks and other assets that will give them a return. So that ends up with higher price to earnings multiples for many stocks, which is what we're seeing. So that's a natural phenomenon. There's nothing in the horizon that we see that would, change that. Particularly because on a third level, we are in a low inflation environment. And one thing that gives investors a lot of confidence is that when the world feels that inflation is under control. Inflation seems to be very close to the Fed's target of around 2%. The Fed has clearly shifted into higher gear now as a result of that. And after the most recent rate setting meeting in mid-March, the Fed basically indicated that we can expect 2 more hikes in 2017. So I don't say it's all full speed ahead, but I would say that given the recovering economies outside the U.S., earnings growth inside the U.S., we'll have corrections for sure, but people that are always concerned about, oh my God, the U.S. is overbought, we don't know. Billions of IQ points are thrown at looking at what U.S. stocks should be valued every single day, and what we see in the market is what they've come up with. So I guess our conclusion is we're happy to take the returns. We're happy to see the foreign markets beginning to recover and pay us for having waited, and on we go. Another little tidbit that I mentioned last call, but it's even gotten better this call slightly, is that we're on the right side of a very competitive world when it comes to investment management fees because we use low-cost index funds, predominantly from Vanguard. Our more popular portfolios, balanced growth and diversified growth, are down 0.16% and 0.12% respectively. The SEC yield on our income portfolio is now at around 4.4%. Schwab and Fidelity lowered their trading commissions, so our clients are now paying $35 to rebalance a portfolio. A few years ago, it was $30 to trade one stock, and that was considered a bargain. Now we're able to rebalance 10 stocks in a portfolio for $35. So it's great to be on this side of the curve. Anyway, that's about all I have to say about the market and performance. Sally, I'm going to give it back to you, and I know you had a few questions.
I did. Wayne from California sent in a question saying that I see your investment committee added PFF to my portfolio. Why?
Well, Wayne, we did notice everybody about this, so hope you're checking your email. We never make any changes or rebalance portfolios without notifying our clients. But yes, we made probably the second major change to our portfolios over the last 5 years. And that was, and only in the income portfolio. So this does not apply if your portfolio has the word growth in it. But for those with an income portfolio, we added a new asset class, and the asset class is preferred stocks. And we can send you, if you send us an email, we'll get you some information on this. But we made a decision based on a lot of fundamental research from Professor Burton Malkiel, who's on our investment committee out of Princeton, and some other work we've done, that the asset class of preferred stocks is an important asset class that we think has been largely ignored by the markets recently, and is a really good way to diversify for an income investor. This asset class they're technically stocks, but they're almost like bonds. They sit between stocks and bonds. So if you're a big corporation and you've issued preferred stock and you go broke, the bondholders get paid first, then the preferred stockholders get paid, and then the common shareholders get paid. So preferred stock has a little lower risk in the event of a bankruptcy, but they also pay like a bond. They pay a set amount of interest, which is actually considered a dividend and taxed at a lower rate if you have this in a taxable account. So the preferred stock asset class currently is paying around 5.3%. We were able to take some allocation off the other asset classes by including this, which again gives us great diversity. And it is our best way of combating a very low interest rate environment to give income investors a little bit of a better return. So Wayne, if you have any further questions, just reach out. We'll send you a Wall Street Journal article that Professor Malkiel wrote about this topic, but we're happy to have preferred stocks in our personal portfolios and in our client portfolios. Okay, Sally.
Okay, great. And then the second question I had from Angela from New York, wanted to know what you think about Trump's tax reform and if there'll be any impact for retirement investors.
Actually, that's a great question. And if you Google MarketWatch, today, if you go on and look at the marketwatch.com, I wrote an article about tax reform. They asked me to give my take on this. And you can read my article, but the long and short of it is that there's really no impact for retirement investing. There's nothing in the tax reform proposal. And by the way, you can make yourself crazy and waste a lot of time reading these proposals that come out. But as Trump says, it's an opening bid. I mean, there's a lot that will change over time. But there's nothing in there that would say, hey, we're no longer going to give investors a deduction for contributing to a 401k or an IRA, which could be a problem. If they do succeed in getting the corporate tax rates lowered and they allow for some amnesty and repatriating all of the money overseas back into the U.S., that would be good for stocks. That could help stocks and help retirement investors. But there's really nothing specifically in the tax code reform proposal that would say, hey, this is going to have a big impact on retirement investors. The issue about not paying for this and how this is going to be paid for, I think that's all going to be negotiable, and I didn't choose to comment on that at this point. But I would say nothing to worry about, a few things to be a little bit optimistic about, but let's just see how it all plays out. Anyway, I want to move on. In your quarterly letter, Q1, the spring quarterly letter, we wrote a little bit about casinos because when you do index investing, it's very hard to come up with a proper metaphor for what we're really doing. And so I tried to write something for our clients that is about as close to a good metaphor as possible. And that is this. whenever you own a mutual fund, whenever you are trying to manage your own stocks, whenever you're trying to make decisions to do better than the market, remember, you are choosing to try to beat the house effectively because at Rebalance, we don't try to beat the house. We just want to own the house. And it's important to really understand what that means. But let's go to the casino first to begin this analogy. When you go to a casino, most everyone I know who does is always prepared to lose money, and they have a justification already baked into their mind about, well, I had some fun, or well, I brought $100 and I was only, that's all I'm going to lose. And so, they go from table to table or whatever your game is, craps. My wife loves craps, and people play and they play and they play and they have a good time and they're entertained. But over time, anyone who's done that for any extended period of time has lost money. Because even though you can be up and feel the exhilaration of success at any of these games, over time, the odds are stacked against you, which is why these casinos are operating the businesses that they're in. They're not there to have you take their money. And so if you in the quarterly letter, we looked at MGM and we looked at their stock price. And basically, over a long period of time, MGM and probably other casinos that are well run, they make money, and they have statistical models that show how they can make money on each game. And so MGM is the house because they know that as long as the roulette wheel is run enough times, as long as the people are at the craps table enough hours, they will win money, and they know how much based on how much is gambled. And it's a fairly predictable business when you're MGM, when you're a casino. If you're on the other side, if you're a guest trying to play against it with a myriad of systems that you might have, it's very unpredictable. And so that's why the casinos make money and the guests lose money. And in fact, the casinos love to give the guests drinks so that they anesthetize the pain of losing money. We see Wall Street and the financial services business as a very, very similar metaphor. There are brokers who sell the latest mutual funds that are outperforming the market, that have the Lipper 5-star ratings, that have Morningstar ratings that are 5-star, that show amazing performance results. There is the guru money manager in the ads that I've been seeing in the papers lately who's outperforming. Everything is about outperforming. And so that's the siren song of Wall Street, is that yes, we can do better. You want to do better. We all want to do better. But the fact is that if you shift to the Rebalance way, which is the house, we don't try to pick anything other than own all of it. So instead of trying to pick what might do better, we are just trying to find a really intelligent way to own everything. And that's what your portfolios do. They own everything. House odds are very predictable. Very predictable. There's never been a time where a balanced portfolio like Rebalance has lost money in a 5-year period, rolling averages, including the tech bubble bursting, the '08 recession. The markets, the global markets, and what they do is very, very predictable. So if you want to be the house, you do what we do. You just own everything, and you own it in proportions that make sense for you. If you want to be like the guest, you buy mutual funds, you buy into the siren song that somebody knows how to do things better, or you even use your own money and try to pick stocks individually. But I hope you read this little quarterly letter that we wrote. I think it's a very, very good metaphor. And I think the real question becomes for all of us individually, why is it so compelling to believe that even in the face of all of this evidence, we still believe somebody might be able to figure it out and do better? And it's a very compelling thought. And maybe we're just wired to believe that somebody out there is smarter and can outsmart everybody, and we can figure him out or her out and hire them. But it's just not the case. There's abundant evidence saying that this never works. So if you're serious about your retirement money, you want to sleep well at night, stay the course with Rebalance. Anyway, Sally, that's about it. I think you have a few more questions, right?
I did. I had a couple questions, both from California, actually. The first one is recently, this is John, and he said that recently he financed his home with a 30-year fixed mortgage at 3.9%. which included a cash payout for remodeling some bathrooms and the kitchen. The bathrooms are completed, but the contractor just informed him that they can't start the kitchen until October. So he wanted to know whether or not he should invest the cash on hand instead of it sitting in a savings account at his bank, and he welcomed any suggestions that you might have.
Great. So we're doing this here today in end of April. So this is a 6-month issue, and yeah, John, I feel your pain. You're paying almost 4% for this money. You thought you'd be spending it right now. Now you got to pay for it for 6 months and not getting anything for it. So let's break this problem down. Whatever the cash is you have on hand, I don't know how much it is. I don't know what bathrooms or kitchens are costing in California. Let's call it 50 grand. You have a 6-month problem. You have a 4% loan, so you're paying 2%. This is costing you $1,000 to sit on the money. The problem is if you want to invest it in anything that will pay you more than 1%, you have to take some risk. We have a term in finance called the risk-free rate of return. The risk-free rate of return means what return can I get without taking any risk? And that's generally expressed by what a U.S. bond will give you. Because in finance, it's considered that the U.S. government is the safest risk-free way to invest your money in debt of the U.S. government, because the U.S. government can always pay you back because they can always print up more money. So it's the risk-free rate of return. The money you can get by loaning the U.S. government money is between 1% and 2%, depending upon the time frame of between 2 and 10 years. So that's not much. Anything else is going to take some risk. So you might say, well, geez, if I could get 4%, I'd certainly invest the money short term. The problem is if you're going to invest money for a 4% return, and our income portfolio can give probably about a 4% return. If you're just talking about a matter of months, there could be volatility in the portfolio, and by the time you need to use the money, we could be down 4%. Our safest portfolio, I think, is a great cash substitute for people who might have a 1 to 2 year time horizon. But 6 months, I just don't think there's anything that you can do where you can get enough return to make it worth the risk that you wouldn't have that money in your hands when you need it for the kitchen remodel. So long-winded answer, but one that I think expresses the dilemma we have today with low interest rates. Leave it in the bank, pay the $1,000 of interest, take it up with the contractor. Maybe he'll give you a discount. Anyway, that's all I have to say for you, John. And again, call us if you want to talk about it further.
Okay. All right. Well, let me give you then the last question from Kara of Menlo Park. She says, Rebalance IRA is managing my traditional IRA, and I love the service. I have to make a selection for my 401k at work, and my company doesn't help at all. She said she looks at her IRA and her 401k totals as one big amount for retirement, and wants to make sure that the selections she's making are consistent with how Rebalance IRA is managing her account. Any suggestions?
Yeah, actually, I'd like to compliment Kara for when she said she looks at all of her money as one big amount. So many of us look at, we have all these various accounts, and they're all with a different allocation, and that's a really dangerous way to begin managing for retirement. So it's great Kara looks at it all together. And anybody who's got various rollover 401k accounts stranded out there, you definitely should call us and roll it all into your IRA, because otherwise everything's being disjointed, meaning that in one account you could have 80% of your money in a bond fund and 20% in stocks. And if you're in your 40s, that's a really, really bad allocation and throws everything else off. So Kara, basically, as a client, we'd be happy to look over your 401k options and match the right options to your IRA. And we extend that to all of our clients who are working with us. If you have a 401k or you have some other accounts out there that we can't manage or aren't managing, we'd be happy to look at it and try to make sure it's holistically managed with your IRA and the money that we are handling for you. We have a lot of clients over time, as they get more comfortable with us, calling us up and rolling over old 401ks, or just having us put a second set of eyes on the 401k they have at their current job and making sure it's all consistent. So we'd love to do that. A lot of times we'll look at the target date funds that are available and try to match that up, but oftentimes those are very expensive and we have to piece together some of the other options for you. But your advisor would be happy to do that for you at Rebalance IRA. But anyway, Sally, let's
okay.
Wrap this.
Great.
Yeah.
Well, that's all I had in terms of questions this quarter. Mitch, did you have any closing remarks?
Yeah, I want to mention a program that we started. As many of you know, Scott Puritz, my partner and managing director at Rebalance IRA, was the only investment advisor that was asked by the Secretary of the Department of Labor, Tom Perez, who's now head of the Democratic Party. Scott was the only advisor that Tom Perez handpicked to go before the Senate and testify as to why these regulations that were out there proposed by the Obama administration were so important. And it really boils down to a very simple idea, because this stuff can get very convoluted and tricky. But basically, the Department of Labor and we, and particularly Scott, was very supportive of these regulations, basically say that, hey, if you're a broker or an insurance salesman or anybody out there pitching financial products, if you're going to pitch for somebody's IRA money, the money that they're relying on for retirement, you can't make a commission doing that, because there's no way you can really have your head in the game and that person's best interest at heart. It's just impossible. You could, so Mr. Broker, if you want to sell or manage people's money or help them with their retirement accounts, you can't take a commission. Now, you can do what we do, Rebalance IRA, and you can charge a small fee for overseeing the assets and managing them, but you can't take a commission. And that, according to the Obama administration, I think the numbers, just the fact that these commissions are charged, are costing people over $15 billion every single year as a tax on America's retirement savings. So we've been very, very adamant as a firm to support these rules, because we just think, as a firm, part of our job, our civic responsibility is to make sure that our industry does the right thing for clients. And we see so much bad behavior out there. At any rate, one thing that we figured out is to create a program so that people can really figure out what they're paying in fees, because most people have no idea. If you're a Rebalance IRA client, chances are you're part of the 1/3 of our clients that came to us asking us to look at your fees and giving you a second set of eyes. And when you found out what you were paying, you were shocked and realized that you had to make a change. Well, most people need a little help, and they don't know how to get to the bottom of it. In fact, they'll call their broker and say, what am I paying in fees? And the broker will say, well, you're not paying anything. And we know that's not true, because brokers are not in business with their names on buildings by not being paid fees. So we created a program, and it's a brilliant program, if I do say so myself. It's called Dear Advisor. It's a very simple program. You can find it on our website. Just go to rebalance-ira.com and look at the very, very bottom. There's something, I believe it says in orange on the footer about learning about what your investment fees are, or you can just go to rebalance-ira.com/dear-advisor. And what it is, it's a great program. You can forward it to your friends, but get us an email address and we'll send you a letter. You can take the letter. It's a nice, well-written letter, but you can send it to your advisor, and it'll make your advisor give you the real answer on what your fees are. It'll make your advisor disclose your mutual fund fees, the fees you're being paid, commissions, everything. And unfortunately, you need a letter that has been written with an expert, so that when the advisor reads it, he realizes that you're very serious about the question. And the Dear Advisor program does that. So we had a lot of clients forward that to their friends and say, hey, I'm working with this firm and this is a cool thing. You might want to use it to figure out what you're paying. I was paying too much. It's just a great way to help a friend out, to refer a friend to our service, and in any event, just help more people understand what they're paying for so that they begin to get the right advice at the right price. So at any rate, I just wanted to bring that up because we rely on you, our clients, to spread the good word about Rebalance IRA, and this is a fantastic tool for doing so. There's a great little video, and it's just a relief for a lot of people when they figure out what they're paying for investment advice. So anyway, that's all I have to say, Sally. Thanks.
Okay. Well, thanks, Mitch. And just a reminder that a playback of this call will be available on the Rebalance IRA website at rebalance-ira.com/conference call. We'll also be sending out an email to all of our clients as a reminder. So thanks, everyone, for joining us today.
And that concludes today's conference. Thank you for your participation. You may now disconnect.